Over the last few years, the global economy has been under significant strain because of high inflation and high interest rates, and it looks like the cracks are finally starting to show. This has left some wondering when the economic downturn, aka recession, will come. Others arguing that it's already happened, and a few believing that it may never occur at all. That's why today we're going to explain what a recession is, when it could begin, and what effects it could have on the economy and the markets. Stay tuned. Let's start with what a recession is. A recession happens when the economy slows. The practical effect of a recession is that lots of people lose their jobs and the markets see massive losses. Now, the last recession arguably occurred in 2007, and it resulted in an unemployment rate of 10% and a market crash of 55%. Now, I say arguably because there's been lots of debate about what counts as a recession. One popular adage states that a recession is when your neighbour loses their job, and a depression is when you lose yours. The technical definition of a recession, however, is 2 quarters of negative GDP growth. For those unaware, each quarter is 3 months long, so 2 quarters equals 6 months. As for GDP, meanwhile, it stands for Gross Domestic Product, and it's meant to measure the economic output of a country. GDP measures include consumer spending, investment, net exports, and government spending. Keep that last one in mind. We'll come back to it in a second. As some of you will know, the US economy experienced a technical recession back in 2022. That's because GDP declined in the first 2 quarters of that year. As such, many have argued that the recession already happened, i.e., that it's now behind us. The catch is that an official recession was never declared in 2022. So, this begs the question of who decides when the economy is in a recession. Well, in the United States, the answer is the National Bureau of Economic Research, or NBER, a non-profit organization. What's crazy is that just 8 economists decide whether there's a recession or not. What's even crazier is that nobody knows the criteria they use. So, in other words, a group of 8 people at a non-profit decide whether a recession has happened, and nobody knows how they make this decision. To add insult to injury, the NBER has a history of announcing a recession long after it started. It took them until December 2008 to declare the 2007 recession. By that point, unemployment had already risen to 7%, and the stock market had already fallen by 45%. Now, obviously, this lag isn't helpful when it comes to figuring out what to do with your job or your portfolio. Ideally, you want to know a recession is coming before it happens, so that you can adjust accordingly. In theory, this is as easy as assessing whether the economy has experienced 2 quarters of negative GDP or not. However, if you had followed this approach back in 2022, then you still would have been late. That's because the GDP data for Q1 and Q2 didn't arrive until August 2022. It takes months for this data to come in. Meanwhile, on the flip side, if you see that GDP growth is increasing, then you may be tempted to change jobs or buy more assets, expecting the good times to continue. The problem there is that GDP includes government spending, which has gone off the rails in the US and elsewhere, presumably because of all the upcoming elections. The result is not only that GDP has been abnormally high, but many of the other indicators you would normally use to assess the health of the economy have become distorted because of fiscal policy. For instance, unemployment remains low while the average person simultaneously struggles to find work. In practice, then, predicting a recession and assessing when we're in one requires doing the work to dig into the data to find the answers. That's what we will do next, and at the end of the video, we'll examine how long a recession could last if it comes, as well as what it could mean for your job and your portfolio. And if you're enjoying the video so far, by the way, be sure to smash that like button and subscribe to the channel so you don't miss the next one, and consider sharing it with someone who you think needs to hear this info.
Are you ready for deals? Are you ready for trading fee discounts? Are you ready to save some money? If the answer is yes, then you're ready for the Coin Bureau Deals page. Yes, Coin Bureau brings you the very best deals and promotions in all of crypto. You won't find offers like these anywhere else.
Discounts on the best hardware wallets! Exchange sign-up bonuses of up to $60,000! Trading fee discounts of up to 60%! Coin Bureau's brand new altcoin-focused subscription service! The Coin Bureau Deals page is even better for you than this piece of succulent, protein-rich, nutritious grilled chicken!
Head on over to coinbureau.com/deals or click the link in the description below. Don't delay. Check out the Coin Bureau Deals page today.
These deals are so hot, I need to cool down. Yeah!
Okay, so now that we understand what a recession is and the effects it can have on the economy and the markets, we can take a closer look at which indicators we can use to predict when a recession could begin. As you can probably imagine, there's no shortage of such indicators, and none of them are perfect. The most popular recession indicator is an inversion of the yield curve, aka short-term interest rates being higher than long-term interest rates. For reference, this isn't normal. Normally, long-term interest rates will be higher than short-term interest rates to compensate lenders for the opportunity cost. When short-term interest rates are higher than long-term interest rates, it basically tells you that investors are expecting the economy to weaken in the future. Funnily enough, these expectations of future weakening essentially occur because central banks have raised short-term interest rates. When central banks raise short-term interest rates, it makes it unprofitable for most banks to lend. This reduces lending and borrowing, reducing economic growth, eventually causing an economic contraction, a recession. It's believed that it can take up to 2 years for this so-called lag effect to affect the economy. Now, given that it's been roughly 2 years since the Federal Reserve started raising interest rates, we're nearing the upper bound of when the lag effect should kick in and cause a recession. The caveat, though, is that all that aforementioned fiscal spending could be kicking the lag effect can even further down the road. More about that in the description. Moving on. Now, the key takeaway with the yield curve inversion is that it's unclear how long it takes until it causes a recession. Even so, it's useful insofar as it tells you that the conditions for a recession are in place. That means all we need is an indicator that can give us some more insight into the timing and severity. Well, one such indicator is called the Duncan Leading Index, which looks at specific measures within the GDP figure, particularly those related to personal consumption and private investment. The logic is that it's fundamentally these areas of the economy that drive real economic growth, which does make sense. The Duncan Leading Index then takes these specific measures and compares them to broader GDP growth to get a sense of how much of that headline number is actual consumption and investment versus reckless government spending. When that ratio starts to fall, it suggests a recession is on the horizon. According to EPB research, the Duncan Leading Index started rolling over in 2021. Considering that it seems to have a 2 to 4 year lag, then it could be another year before the recession sets in. You might think this isn't useful, but it is because the severity of the recession can be forecasted using this indicator. Considering that the Duncan Leading Index seems to be in freefall, this suggests that the upcoming recession, if it occurs, could be severe. I'll quickly note that the Duncan Leading Index we showed you here is a modified version created by EPB Research. The link to their video about it is in the description. Anyways, seeing as leading indicators suggest that a recession is indeed coming, All we need now is a few to tell us when it's actually here. Well, one of these is called the Salm Rule Recession Indicator. It's named after economist Claudia Salm, who found that recessions tend to occur around the time that unemployment in one quarter is rising faster compared to the last 4 quarters. This underscores something that you always need to remember when analysing economic data, and that's that it's ultimately the rate of change that matters. If unemployment is slowly rising or slowly falling, then it typically has a negligible effect. If it happens all at once, though, the effects can be big. As you can see, the Salm rule has accurately predicted every recession we've seen over the last few decades, and much sooner than the NBER. The catch is that the rule tends to be triggered a few months after the recession has already started. This is mainly due to the indicator using a 3-month average. The Salm rule is still worth mentioning, however, because we can use it to confirm when the economy is actually in recession, at least in the US. For confirmation that the US is in recession, the Salm rule needs to be above 0.5. It's currently just under 0.4 and rising steadily, suggesting weak economic conditions. If the unemployment rate for May rises more when it's published on the 7th of June, then it will be safe to assume that the Salm rule will reflect that fact in a few months' time. Put differently, it will provide further confirmation that the US economy is headed for recession. Mark your calendars. Now, as you might have gathered, most of these indicators are inaccurate because they rely on lagging data that's often revised. Unfortunately, there's no getting around this because it takes time to gather data about the economy and even more time to analyse it, particularly in the public sector. Fortunately, though, there are a few more real-time indicators we can use to get a sense of whether the US is in a recession or not. Oddly enough, one of these is apparently unemployment by state, which is likewise published every month. For context, unemployment means that you're looking for work but can't find any. Now, according to former Fed advisor Danielle DiMartino Booth, when the unemployment rate is rising in every state, then historically the US has been in recession. Well, the unemployment rate in all 50 states rose in October last year. As a result, Danielle believes that the US has been in recession since October 2023. Additional evidence for this can be found in the earnings of major retail outlets and fast food companies, such as McDonald's, which had a rare earnings miss due to people being unable to afford its food. Of course, McDonald's is supposed to be cheap, yet it's becoming unaffordable for many. Starbucks, Pizza Hut, and KFC were other food chains that experienced an unexpected contraction in earnings in Q2. What's strange, though, is that Chipotle managed to buck the trend by beating estimates. Macro analyst Jim Bianco believes that this is because Chipotle portions are large enough to eat for 2 meals. Whatever the case, by this point you're probably wondering why we're focused on the US. Well, the short explanation is that the US is the world's largest economy. As another popular adage states, when the US sneezes, the world catches a cold. If the US goes into recession, the rest of the world will too, and worse. Anyhow, knowing that a recession could be imminent, the next step is to assess exactly how severe it could be, assuming it happens at all. If you've been listening to lots of content about recessions, chances are that you've been given the impression that the next one will be as severe as 2008. This, though, seems unlikely, at least in the US. That's simply because there isn't as much debt. More accurately, there isn't as much floating rate debt. Recall the inverted yield curve and why it predicts recessions. Besides making lending and borrowing more expensive, it also makes existing loans more expensive. The thing is that only 11% of household debt in the US is floating rate as of 2023. In plain English, most of the household debt in the US isn't being affected by higher interest rates, and the same is true of corporate debt. Only around 16% of corporate debt will need to be refinanced in the next 2 years. To be clear, This doesn't mean that the average person isn't struggling. They most certainly are. However, there is a large portion of the US economy that has been relatively unaffected by rising rates. Those with lots of cash are even benefiting as they can earn over 5% on their massive piles of money. It seems that the consequence of this dynamic has been a sort of rolling recession where certain segments of the economy are strong and others are weak. White-collar jobs are an easy example here. Big tech companies continue to cut their headcounts, but home builders are, or were, struggling to hire. For there to be a 2008-style recession, there would need to be some major catalyst, like for instance the collapse of Lehman Brothers, which caused financial institutions to stop lending to each other overnight. Today, there only seem to be two catalysts: commercial real estate and banking, and the government itself. Now, if you've watched any of our videos about the commercial real estate or banking crises, you'll know the two are intertwined. The TLDR is that many small and medium-sized banks invested in office buildings which have since become almost worthless due to the increasing tendency to work from home post-pandemic. While the collapse of these small and medium-sized banks wouldn't be enough to cause a crisis, the resulting run on bigger banks would be. This is precisely why the US government bailed out Silicon Valley Bank. If it hadn't, it could have caused runs on other banks that would have threatened the banking system. And speaking of the US government, all the spending that it's been doing to prop up the economy has simultaneously created a fiscal problem that could trigger a real crisis. To put things into perspective, the US government is apparently spending as much as it does during recessions, only there isn't one. Makes you think. In any case, a lot of this spending is being financed by borrowing. This involves selling pieces of paper called bonds to investors. These contain a promise to pay them back the borrowed amount plus interest. Naturally, there are concerns that bond investors will be less likely to buy if this spending continues. That's just because this spending is likely causing a lot of the inflation we're currently seeing. If it continues, then the value of $100 being lent at 5% interest today may only be worth $80 in real terms by the time it's paid back. To compensate for this, bond investors will want higher yields. The issue is that the US government would have difficulty paying these higher bond yields. The bigger issue, though, is that this would translate to lower bond prices, and US bonds are the primary form of collateral in the financial system. If they lose their value too quickly, the global financial system could implode. Barring these two catalysts, though, the recession is likely to be mild and short-lived, if it comes at all. As we've learned, it's possible that we're already in it, and it's even possible that we're already exiting it. Some countries, such as the UK, are reportedly coming out of their recessions per their Q2 GDP prints. Anywho, this brings me to the big question, and that's what effect a recession would have on the economy and the markets if it occurs. Make no mistake, these are two very different things. The former has to do with your job, and the latter has to do with your portfolio. Now here is where things get interesting. Historically, the economic effects of a recession have been felt the most by those working in industries closely related to consumption, such as retail, hospitality, travel, and manufacturing. This is why many analysts focus on manufacturing-related indicators to spot recessions. As with the unemployment rate, though, the manufacturing indicators have been warped by all the fiscal spending, which is focused on infrastructure development. More importantly, this means that you're unlikely to lose your job if you work in manufacturing if a recession comes, at least on paper. In case it wasn't clear enough, those of you working in areas like retail, hospitality, and travel may be at risk of losing your jobs, but only if there's a severe recession. As I mentioned a few moments ago, a severe recession is unlikely unless something in the financial system or the economy breaks. Note that this catalyst doesn't need to be domestic per se, it could be geopolitical. Food for thought. Now, when it comes to the effects that a recession could have on your portfolio, this really depends on the assets that you hold. It goes without saying that if you hold stocks belonging to companies in the industries that are likely to be most affected, your portfolio will probably take a beating. Again, though, the exception is manufacturing, where companies could continue to perform well due to infrastructure spending, regardless of any recession. If you're wondering which companies specifically, just look at what exactly governments are spending money on. Microchips, weapons, energy, the list goes on. Similarly, commodities could paradoxically perform well during a recession insofar as they're used in the infrastructure projects that governments are funding. Assets such as bonds would probably rally, as there would be a flight to safety from other assets, namely risk assets, but this depends on inflation. If inflation is low when the recession starts, then bonds will perform well, and risk assets that are sensitive to money printing, like crypto, would be the first to rally after the FUD-driven dip. Note that there wouldn't even need to be any money printing per se. Investors would expect it automatically. But if we enter a recession and inflation is high, then bonds may not be the safe haven to turn to. Instead, inflation hedges such as gold would be better options. As a fun fact, investors tend to accumulate gold leading up to bear markets and recessions. Say, did you hear that gold recently hit an all-time high? Now, in all seriousness, inflation could complicate things. And when you combine high inflation with economic weakness, you get stagflation, which is notoriously difficult to get hold of. That's because stimulus causes more inflation, whereas raising interest rates to fight this inflation causes more economic weakness. This is extremely important to point out because if you're into crypto or other assets that benefit from money printing, you need to know that this stimulus may not come right away if the recession is coupled with high inflation. Recall that it's assumed that the money printer will just turn on at the first sign of a recession. Aside from the fact that this stimulus may not come as quickly if there's high inflation, it may also not be as big as investors expect. This is because of what I just mentioned a few moments ago, the risk of more inflation. According to famous hedge fund manager Ray Dalio, we would likely see a mix of everything. We would see a combination of governments reducing their spending, restructuring their debts, redistributing wealth from the rich to the poor, and central banks printing money. As Ray highlighted in his video about how the economy works, these tools will need to be balanced in order to deleverage without issues. The impact on the markets in a stagflationary environment will therefore be mixed, and it will require more active rather than passive investment. This is something that's been predicted by many market analysts, and this prediction seems to be coming true. If history is any indication, though, we ain't seen nothing yet. And that's all for today's video, folks, so if you learned something new, be sure to smash that like button to let us know. If you want to keep learning, subscribe to the channel and ping that notification bell. And if you want to help others learn about what a recession is and whether it's coming, share this video with them. As always, thank you so much for watching, and I will see you in the next one. Adios, arrivederci, auf Wiedersehen, au revoir, goodbye.